Hey, Nelson, thanks for making the time today. And today we're going to go through the state of the property market and your experiences with syndication, property syndication, which I'm dying to hear more about. Tell me a little bit about your background, Nelson.
So to sum it up, I'm an engineer by trade. I've got 20 plus years experience in the property development game. Worked for quite a few big boys in terms of the ASX listed property development companies. And yeah, so I work for a few privates. I still do the odd deal here and there. I am a fully licensed real estate agent, and I am doing mortgage broking at the moment. I'll probably touch a bit more about my background in the second part. But let's dive into it, shall we?
Sure. How long have you been involved in property now?
Well, I came out worked for council when I first graduated. Didn't really like it, and then I jumped into property development. So 22 plus years,
Oh,
roughly.
wow. Okay.
Yeah,
That's quite a lot
yeah,
of experience.
yeah. You
Cool.
could
Kick
say
us
that. Yeah.
off.
All right. So I'm not sure if you can see my share screen at the moment.
Yes. Yep.
Okay,
Okay.
done. All right. So I've broken it up into two parts. The first part is basically the state of the property market, and then sub-broken it into apartments, new apartments, and new land lots. We can talk about the existing properties at the back end of the first part. But basically, let's just jump into it.
Cool.
Um, okay, so we're talking historics at the moment because it takes time for agencies like Charter Care Kramer and the rest to actually consolidate the data and then produce it. So what I've done is based on all the research papers available to the industry, I've just summed it up very on a very high level, and I've highlighted basically what the market is doing. This is now 6 months old, but it's not that far off from what's happening at the moment. So if you have a look at the apartments scene at the moment,
Mm.
I've only picked up the first the biggest six states, being by order: New South Wales, by population basically, New South Wales, Victoria, Queensland, West Australia, South Australia, and the ACT.
Mhm.
You know what we can see at the moment is the launches, which is the sales at the moment off plan. These are the numbers, and from a year ago, basically New South Wales, the actual number of apartments available on the market has dipped 48%. You've got Western Australia at 40%, and then South Australia is pretty bad at 75. However, the ACT, because of the short supply in land lots, is actually experiencing more apartments on the market. We can talk a bit more into each market segment at a later stage, but this is just a quick
Sure.
snapshot. In terms of commencements, which is what's under construction, 8,300, 10% lower, 10% lower for Victoria, 40% lower for Queensland, 50% lower for Western Australia. South Australia is 10%, which matches the other two. Whereas as you can see, the ACT is 86% more. That pretty much means that ACT at the moment is flooded with apartments because of the lack of land lots. I'm not saying there are no land lots. It's just there's a lack of them, which is
Mhm.
why a lot of the big boys, the developers, have actually exited the Canberra scene or the ACT scene. Some developers are going next door into the Queanbeyan area to develop.
Mhm.
But the big boys like your land leases and all that, they've exited the market in the landlord space or residential community space. It's also a weird one because the ACT with the 99-year lease, and basically a lot of land is still owned by the government, and
Yep.
they have their own development arm. So there's kind of like a small conflict of interest there. They're squeezing supply and then offering supply to their own departments, and then trying to push out limited land lots for medium density and high density. So these are apartments basically. So that sums it up in the apartment space.
Okay.
In
If I
the
look at the
new land
data,
estates, what was that? Sorry.
if I look at the data, it looks like a very
Yeah,
big shift since last year.
yeah, correct. It's still lagging,
Yep.
but I'll be able to explain it in a bit more detail when I touch base on the median house prices of units, which includes apartments and dwellings as well.
Okay.
So we now talk about new land. We're talking about englobo land, so greenfield land estates. So basically, developers buy big blocks of land off farmers, and then they do the cookie cutter cut and carve and sell it as land lots to the mums and dads and investors to build their houses on. Historically, you know, we've peaked during the COVID, surprise, in one of the quarters at, you know, over 7,500. At the moment, this is September's quarter. We're just under 2,900 for the quarter. Okay, this is talk about per month sales, net lot sales. So what does that really mean? This is a quick snapshot from Research 4. It's meant that there's a 21% rise in sales volume from the previous quarter, right? The national price is down 1.5%. So basically, we haven't really been experiencing a massive correction. Perth and Adelaide are reporting strong sales price growth, and I'll explain exactly why that's happening at a later stage. On the eastern seaboards, so Queensland, you know, New South Wales, Victoria, in order to keep the sales pricing the way they are, because every time the developer drops their pants to sell blocks of land, they're shooting themselves in the foot, because the previous stages that were released sold at that particular price would then be under pressure when it's time for settlement for valuations. So they have to maintain pretty much their sales pricing, and the only way to get more sales or more traction is to offer rebates. And we're slowly seeing rebates creeping back in.
What kind of rebates?
Rebates, things like you know, a settlement rebate, might be a $3,000 rebate, might be a front landscaping package they throw in, might be fencing, you know, they throw in, you know, things that sweeten up the deal. Melbourne and pretty much matches what they're trying to say. Melbourne, Sydney rescissions. When I say rescissions, it means that the number of lots that people have purchased in the past, you know, because these are all off plan, when it's almost time for settlement, these buyers have changed their circumstances. They might be flippers, in toy marks, flippers. They might be, you know, people who now can't afford to borrow money to build. So the rescissions remain. I don't have exact percentage, but you know, generally speaking, in the industry, 5% return of stock during settlement is about right. I wouldn't be surprised we're getting 15% at the moment. That's just anecdotal. But you know, don't quote me on it. I'm pretty sure we can find the exact numbers when they do come along. My observations, based on what I see at the moment in the market, in the new land estates arena, the lot sizes are becoming smaller and smaller. So pretty much, in order to meet certain price points, when you add up the housing component and the land component, it's got to meet a certain, you know, package price, you know, to hit these people who are trying to look for their first home. Long time ago, I could remember, you know, packages were $400,000. Now in some states, you're talking, you know, $900,000. Cheapest being in Western Australia, you still can get $550,000. There are still some places where you can get house and land packages for a bit cheaper, and we're now talking about the townhouse space, not individual dwellings. There's only a certain amount that you can cut these lots in terms of the width and the depth to make them actually fit, you know, as per you know, some of the design guidelines that developers have in place under Res Code, for example, which is a code that governs you know, small lots and what you can build on them. Because end of the day, most of these lots can't be built on the actual boundaries, because once you start building on the boundaries, they're no longer individual dwellings. They're then called, you know, semi-detached or attached dwellings, which is a different kettle of fish.
How small are the lots getting now?
You know, I've seen lots with a 0 lot line, so semi-detached, going down to about 8.6 meters frontage. Okay. Yeah. So the normal ones without a shared wall or a 0 lot line are about 10.5 meters at the moment. Okay. I reckon that's as much as you can squeeze it down to in terms of frontage. Depth wise, you know, you can probably see them at 22 meters deep at this stage. And obviously, because they're arranged in grid-like patterns, if you're going to have 22 meters depth on one, you can't have easements at the back because it's too short. So the easements will most likely be on the backyard of the neighbor at the back because of the grid pattern. Volume builders, we know what's happening with a lot of builders. A lot of them are going bust. It's especially serious in the Western Australia space because the materials price still really hasn't come to equilibrium or has become steady in a sense. So what basically when we talk about new land lots being released, from the time it gets sold off the plan to a stage where you can actually settle, it's not uncommon to hear 2 years, 2.5 years at this stage, because there's just so much going on at the moment. And it means that if developers are going to then package up a house with a builder and their land to sell, they're actually selling pretty much a futures contract, basically. That's sold at today's rate, delivered in 2.5 years' time, roughly, or 2 years' time. Which then means these builders are very, very careful and worried that if they sign up today, if there's any price fluctuation, because of their margins are so challenged, up until marks, they're really reluctant to sign on new clients for the house builds or build contracts until they absolutely know that the developer has started construction on that particular stage. And even at an advanced level, maybe Kerman Channel is down before they actually start committing, with buyers to actually spec something on their blocks of land. My biggest observation so far is because of the affordability factor, we're going to be seeing a lot of organic migration to Western Australia and South Australia, particularly in Western Australia. And I'll tell you why as we go along in the next few charts. It used to be in a flippers market. When we talk about flippers, it's basically people who line up and buy stuff off the plan. Because it takes 1.5 to 2 years to deliver these blocks of land, they, within that period before settlement, they try and flip it on and make a profit. So it wasn't uncommon to make, on a 250,000 block of land, it wasn't uncommon to make 50 grand on it at one stage. So if you were a mum and dad and you had a 10% deposit, to buy 10 blocks, pretty much in that particular time frame, you can potentially make 500 grand gross profit just by flipping. So that's kind of caught a lot of people out, which is why this rescission remains very high in Melbourne and Sydney, because the flippers are now turning away from buying off the plan land lots. Also, something else comes into play, especially in Victoria, and I'll talk about that later. It's to do with the levies and fees. But
when the rescission happens, does the investor lose their deposit?
Okay, this is a very grey area. If you take it by the contractual terms, the developer can take the deposit. Right. But some developers, depending on circumstances, I'm not saying everyone who returns a block of land is a flipper. There are genuine circumstances. So some people, may get away with it and get their money back. The saving grace on some of these things that may occur, like for example, because the developer is selling so far in advance, their planning permit may not have been approved. When the planning permit gets approved, and as part of the condition, the planning permit says, you must now move this road 1 meter this way, which then means it affects the plan of subdivision, which is your lot titles to be titled at the titles office, which then means your land has physically or technically changed. Your lot description has changed because the coordinates are changed, which then gives you a get out of jail free card, basically, because saying, well, hang on, the product you sold me has changed. It's no longer valid, so I can get out. So there are things, here and there. We go to the next slide, which then tells you exactly why we experience, Perth and Adelaide, or West Australia and South Australia, are experiencing such a massive growth drive. If you look at this slide and this one as well, it pretty much says what the average lot, new lot, is selling for in each state, and it's telling you what the average size is. Now, I've summarized that in a table. Same thing, according to population. So Sydney, Melbourne, or New South Wales, Victoria, Brisbane, Perth, and Adelaide and ACT. Population size, the average lot size. So Sydney at the moment, or New South Wales, is still around the 380 squares. Melbourne is about 350. Brisbane's still about 470. Now,
Wow.
470 is considered large now in Melbourne. Okay. Perth is 375. Adelaide, 442. ACT is 472. Mind you, ACT has a very short supply of land available, as I kind of mentioned. It's predominantly more, units or apartments. Average lot prices, big changes. So Sydney leads the pack, over 700 grand for a block of land. Melbourne it's almost hitting 400, right? Brisbane is 360, so Brisbane's playing catch up. Look at Perth, 228,000. Look at Adelaide, look how cheap they are, these two. Now, when you do then break it down into the price per square meter, these two are the state leaders in terms of price per square meter.
Yep.
Now, the reason why yes, Adelaide is doing good. The reason why I personally believe Adelaide is a shallow market is if you look at the population, it's still under 2 million. There's still a fair way to go. Perth is 2.9 at the moment. And I think the indicators tell me in the coming few years, especially we might get some of this Melbourne, people moving to Perth.
That's fascinating.
Because of the affordability factor.
Because historically, over the last couple of years, people have been leaving Adelaide. Like they get their degree, they go to university, and they move to like a bigger city for opportunities. But now, because of land prices, it might be reversing.
Yeah, correct. I think that I've got a slide on population growth as well, and that would explain to you what's happening as well. I think it might be the next one. No. Okay. Median house prices. So the red arrow is dwellings or houses, and the green ones are units or apartments. You can also look at the gap between the two products.
Yep.
But essentially, what we're seeing is Sydney prices are hovering around there. Melbourne is still hovering. Brisbane is hovering. Look at Perth.
Still growing.
Yeah, it's still growing. Look at Adelaide. It's plateaued a while, and now it's picking up again.
Yeah.
Slowly. Okay. Look at Canberra, and this is purely to do with shortage of supply. And oversupply of apartments. So the apartments prices have kind of dropped. Now, if I was a mum and dad, maybe a first home buyer, and I look at the pricing, right, I can live in Perth and get a house and land package just above 600 grand, right? So why would I move to Adelaide when the average price is 700 plus, right? Doesn't make sense. So this is why my pick would be Perth.
Okay.
Right? Melbourne has dropped down. It almost peaked. I think it went over the $1 million mark for average prices for houses. It's kind of dropped back a little bit. Canberra is as I said, house prices are always high. And then you've got obviously Sydney and Melbourne. But that pretty much sums up what the hell is going on at the moment up until June 23, right? In terms of and then you also have to look at the percentage gaps. So there's still a big gap in Sydney between the two products. Historically, if you have a look, they're all around the 50 plus mark. The only one that isn't is Perth. So that tells me that there is still some more to go this way, right? Because it's a 47% gap. So apartments, as you can see, it's probably historically hasn't really gone up too much. So where I see the actual increase will be in the dwelling space, the housing space.
It also looks like over time that gap has widened. So if I look at the Sydney chart, for example, the price differential between houses and apartments used to be much smaller.
Correct.
But now the demand for houses seems to be higher now, and that's increased the gap.
Yes, correct. And there's also a reason for this, and I think I might be able to tell. This is why. All right, now we talk about migration, hot potato. Okay. This is the one that's I don't think there's been too much media coverage on. Basically, if you look at March to March, last year to this year's March, the amount of people that have called Australia home, new migrants coming in, is over 500,000. Right? Look where they're moving to in terms of changes. Right? The biggest numbers would be Victoria, Queensland, and Western Australia. Western Australia leading.
Surprising.
Right? Very surprising. And this is probably why because of some of these people, most of these are not only working professionals, depending on their visas. A lot of them are actually families. So the 30 to 40 year old category with the 1 or 2 kid, and historically they don't like apartments. So, you know, why buy an apartment when, you know, if I can afford it, I'm going to buy myself a house. And this is why you see, if I go back, you see the differentials. This is during, you know, just after the after pretty much COVID kind of said, oh, see, yeah, goodbye. It's still available. It's still around. Just, you still there?
Yep, still here.
Oh, okay. Sorry, mate. Okay. So that's the population with respect to what's happening. And then we go back, go to my the vacancy rates. Another interesting fact is with this with the number of people coming to Australia to call Australia home, that's fueling the pressure for what's happening with rental prices. And it's very clear if you have a look by region, Sydney, it's still well under the 3% equilibrium. If I averaged out these ones, I would probably say this is sitting at 2%. I would say this is sitting at around 2%. Brisbane, I would say, is sitting at around 1.2%, roughly. Perth is sitting at or maybe below 1%. So, and then you've got Adelaide, same thing. Is sitting at or below 1%. And then if you have a look at Canberra, it's exactly what I'm trying to tell you. Because of the number of apartments available in the market, the vacancy rates is still historically low, below the 3% equilibrium, but it's jumping.
Gotcha.
It's rising. So
Canberra's got a supply shortage of houses, but it's got a supply glut of apartments.
Correct. Yes, you could say that in a nutshell.
Okay.
Because it's just because of what's available for sale. It's a very tightly held market, Canberra is. And which is why the prices are still high. You know, it's not far. If we go back to the past few slides, the average house price isn't far behind Melbourne, right? So that's what's happening. And as I said, you know, the key takeout of this particular slide is, like I said, Perth and Adelaide. And if you're going to talk about population, I reckon Perth is the horse I'll be betting on.
Okay.
Right? Now, from this, my observations, make no mistake, we are in a housing crisis. The rental supplies, as you see, is stupidly low. Especially in Perth, Adelaide, and in Brisbane. Okay, so I forgot to put Brisbane in there. It's not uncommon to see 10+ parties attend to open for inspection to rent a place. It's just stupid out there. So as soon as you know, there's a vacancy, you know, it's open for inspection, say one afternoon. That in that particular afternoon, you probably get 10 parties walk through the first go. Out of that 10 parties, there's a big chance that they would all apply and someone will be selected that afternoon. That's how crazy it is at the moment. It doesn't help with the migration. So this is why the investors are taking the opportunity to increase rents. So it's not uncommon to hear rental increases from anywhere between 15 and 20%, even on existing re-signs. So, you know, basically you sign on a 12-month contract and you want to renew on another 12. It's not uncommon to see a 15% increase. I just had a friend who's a friend as well, a friend's friend. They had a 25% rental rise. So from 400 to 500 for a one-bedder. So that's what's really happening at the moment. As I said, the migration is compounding to the issue, with some offering 1 year's rent up front. Now, in some states, this is illegal for the property manager or for the landlord to actually take a year's rent up front. Obviously, there's conditions and guidelines surrounding that, but you know, or they're offering more rental to secure the actual property. What that translates to is the mortgage cliff that a lot were expecting, with fixed rates coming off and then reverting into variable rate. It really hasn't occurred. I'm not saying it won't occur. It's just it hasn't occurred as we speak. So the mortgage cliff that many were expecting really hasn't occurred. And when I say mortgage cliff, it's those investors or even owner occupiers that had fixed their rates 1 or 2 years and now reverting into variable rate territory. There was all these people were supposed to be financially in hot water. That really hasn't occurred, especially with the investors. And that's because with the rent rises, it's pretty much covering a bulk of the interest rates that are being charged on their loans. I'm not saying it won't occur. It's just now it's instead of a bang drop, it's now probably just a slow correction as we go along.
I think there's a lag effect.
Yeah, sorry?
I think there's a lag effect.
Yes, correct. Yes.
Yeah.
If the migration slows, if the federal government and the state governments with their sponsorships, if they make visas harder for PR residency, permanent residency pathways, then we may see a slowdown of migration, which then would mean more and more product coming back on the market for sale.
Okay.
The mortgage cliff just hasn't occurred. But what has occurred is mortgage prison. Pretty much people who are with their existing funders or banks or institutions, because of the rate rises, if they were able to borrow, say, $1 million, prior to rate rises, they could probably now, on the same financial circumstances, borrow 500,000-600,000. So there's a big change. So if you were to try to refinance and say you owe $1 million, you could afford $1 million, prior to rate rises, you probably couldn't afford $1 million now. So you're stuck with your existing lender, which means that you can't refinance. We call that mortgage prison. Many of these new migrants, apart from skewering the what's happening with the rental market, a lot of these new migrants are also cash buyers. Interestingly enough, some articles do hint at a bulk of these buyers coming from China. I would probably even pinpoint it closer to the Hong Kong people calling Australia home, due to the relaxation of some of the visas being offered and the permanent residency pathways being offered. That's artificially inflating prices for properties because, like many Asian countries, education for their kids remains number one, and it's very, very cutthroat in terms of forcing kids to take tuition and extra activities and whatnot. The number of days on the market has increased, so that's if you read between the lines, kind of. Yeah, there's stock on the market, it's not really selling. But on the other hand, the number of stock on the market, depending on the locations, is still undersupplied because there's still a lot of strong demand for quality properties in some states. So in Victoria, I've given you an example. Very hotly contested suburbs like the Asian hubs like Bowen, Kew, Doncaster, McKinnon, and Box Hill, they go like hotcakes. Most of these suburbs are in the southeast, and that goes back to what I'm trying to say with these Asian cashed up buyers over for a better life. Not sure for whatever reason, political or not, they've just decided to pick up their bags and come over, which means there's pretty much a mass exodus of professionals at the moment in Hong Kong, especially among the younger working force, all the way up to the mid 40s. So there's an intellectual drain at the moment happening. You can see it with teachers, you can see it with nurses, and a lot of IT specialists. They're all coming over because the government has relaxed a lot of these visas for them to come over easier.
Yeah. I'm looking at a migration chart of millionaires at the moment, and Australia had 12,000 millionaires migrate over the last 12 or so months, which is more than Canada at 4,000, United States at 10,000, Singapore at 1,000. We're kind of like the top destination for millionaires. And they seem to be leaving countries like China, India, Russia, and France and UK.
Yeah, when we talk about China, it's predominantly Hong Kong.
Okay.
Yeah, it's predominantly Hong Kong. I'm not saying there's no Chinese coming over, but it's predominantly Hong Kong. That's what I've seen, because I work very close with this community, the Hong Kong community. What I'm also trying to hint at is, you know, I've mentioned that there will be a exodus. I wouldn't say exodus, but there will be organic migration between the states.
Yeah.
It's purely because Victoria's, I think they're about to introduce the short stay levy. So all these Airbnbs are going to get taxed 7.5%. I think that's coming into effect in 2025, off the top of my head. Don't quote me on it.
Yep.
And then the vacant land tax has come into play as well. So who's going to get caught out? All these people that are trying to buy their first home under a house and land package, two contract deal. Basically, they have to settle the land first and then build with the contract. These people will be hit with the vacant land tax.
Okay.
So, and also that's adding to the cost pressures or the affordability pressures, which then means, as I said, you know, if I had this much money, that's all I can afford. You know, rather than live in a shoebox, I can probably buy something a lot better for cheaper in another state.
Yep.
State is, you know, not necessarily Adelaide, because I still believe the employment prospects there are employment prospects, but it's probably not as good. Whereas, you know, in West Australia, it's all about mining.
Yeah.
And interestingly enough, you know, West Australia contributes to the most in terms of GST, you know, to the federal government. So they're actually doing great guns. So don't quote me on it. There's a few articles out there floating around to say which state is contributing to the national budget and to the GST pie, and Western Australia are contributing a lot for. And you know, they're only a fraction in terms of population of what Melbourne is. So just bear that in mind. Oh, sorry. Before I do that, this is from Heron Todd White, and this is pretty much a pulse on the clock. It just tells you the top one is about houses, and then the bottom one is units. It's just giving you an indication based on September's results where cities are with respect to the clock, or the pulse on the clock. So you have a look on the. We'll start off with Sydney. Sydney is.
Are you able to zoom in?
Is that better?
Yep, a little bit.
Yeah. So Sydney is at the start of recovery according to this clock.
Okay.
Right, for houses. Melbourne is at the bottom of the market. Right here, right? In terms of units, the same thing. Melbourne and Sydney are the same, so they're bottom and starting to recover.
Yep.
But where it gets interesting is if you have a look at what gets interesting is if you have a look at what's peaking at the moment. You've got Adelaide peaking.
Yep.
You've got Canberra peaking. All right, in terms of the housing space. In the units or apartment space, Canberra is declining. So that matches exactly what I'm trying to say. There's too many units, right? In terms of the Perth market, Perth is a rising market, and this is why I keep hinting at it. Perth is where developers want to be at this moment, right here.
It's a good chart.
Same here, right? Both products types.
Well, there is a mining boom at the moment, and commodity super cycle tend to last a decade or longer. The last one went from 2000 to 2015, and the current one kicked off around about probably 2020. So we've got a good decade ahead of us in growth in WA.
And on top of that, because of the because a lot of these people are moving over for these jobs, not everyone is in a position to buy. And this is why they're also, you know, going in as tenants, and which is why the vacancy rates are so low, because everyone's trying to hunt for a property.